Thank you. Good afternoon, and thank you for joining us for the National Conference of State Legislatures webinar, The State Impacts of Falling Oil Prices. Today's webinar is hosted by NCSL's Natural Resources and Infrastructure Committee and is part of the committee's 2015 Spring Webinar Series. As a reminder, we will be holding webinars on a variety of topics each Friday throughout May and June. Next week, we will explore the issue of invasive species, and for a complete schedule and registration, please visit our website at www.ncsl.org. My name is Ben Hush, Committee Director for NCSL's Natural Resources and Infrastructure Committee, and over the next 45 minutes, we will explore how the significant drop in the price of oil during the second half of 2014 impacted state economies and, more importantly, state budgets. But before we begin, I wanted to review a few housekeeping items. Our webinar today is being recorded, and registrants will be able to access a recording of the webinar shortly. We'll send out a notice shortly with a link to these resources. Our speakers today are Representative Dan Sadler of Alaska, Vice Chair of the House Finance Committee, and Brian Sigritz, Director of State Fiscal Studies at the National Association of State Budget Officers. Our presenters will be taking questions after we finish both presentations. Please type your questions in the question box on the lower left side of your screen. Without further ado, let me introduce our first speaker, Representative Dan Sadler from Eagle River, Alaska, a suburb of Anchorage. As I'm sure most of us are aware, Alaska has been one of the most impacted states when it comes to the effects of the price decline. As he is the current Vice Chair of the House Finance Committee, Representative Sadler has a front row seat to these impacts. He has been intimately involved with how the legislature is responding, and he is kind enough to join us today to give us an inside look. With that, Representative Sadler, the floor is yours.
Well, thank you, Ben, and thanks to NCSL for the chance to do this webinar. Boy, I hope there's no fires or emergencies there. I hear the sirens, but this is Representative Dan Sadler. I am a third-term Republican representing a veteran community about 10 miles north of Anchorage called Eagle River. Just a little bit of background, my past legislative assignments included chairing the Veterans, the Joint Armed Services, and the Resources committees, and I'm now Vice Chair of the Finance Committee, which in Alaska deals both with revenues and with budgets. And it's a pleasure to talk with fellow state legislators and staff and interested parties about Alaska. Of course, talking to you about how the crash in oil prices is affecting our state isn't the happiest of topics, but it is important to us, and I appreciate your interest. I hope that our experience can be instructive and helpful to you, and if not instructive and helpful, at least I hope you find it amusing. It's going to be valuable to go through some background about Alaska's relationship to oil before we get to how we're actually responding to the change in oil prices. So, historically, Alaska became a state in 1959 largely on the promise that we could pay our own way with revenue from Cook Inlet oil, about 100 miles south of Anchorage in the Kenai Peninsula. But in 1968, I think it was Sinclair discovered Alaska's largest oil field at Prudhoe Bay on our northern Arctic coast, which we call the North Slope. This really is what created modern Alaska economically and politically. We received our first $900 million in lease bonus payments at a time when the entire state budget was only $118 million. And after what they kind of jokingly refer to as blowing that money on public infrastructure by 1973, the state of Alaska settled down to enjoy the continuing wealth when oil started flowing through the Trans-Alaska Pipeline in 1977. How we responded to that money, we repealed our state income tax in 1980, and per capita income and state government spending rose tremendously to the highest levels in the nation. In 1976, Alaskans created what we call the Alaska Permanent Fund, which is designed to save a portion of our oil wealth against the future day when oil could not pay for state government. Just a bit of background on that, the Permanent Fund receives 25% of all mineral royalties, plus occasional direct deposits to the principal, such as from excess earnings. The Permanent Fund balance now stands at about $52 billion with a B dollars, up or down depending on the stock market. And of course, there are just over 700,000 Alaskans, so we share that $52 billion in common. In 1980, Alaskans created the Permanent Fund dividend. About half of the fund's annual earnings are plowed back into the principal for inflation proofing, but the remaining half is distributed as the Permanent Fund dividend to each qualified and applying Alaskan. In recent years, that dividend, or the PFD we call it, has been between $1,000 and $2,000 and was about $1,884 last year. It's based on a trailing 5-year average of earnings, and so it goes up and down. And when the last bad year stock returns went down, our PFDs went up. As you can imagine, the PFD is the third rail of Alaska politics. If you are ever perceived or castigated as raiding the permanent fund, then you can immediately start making plans for life after public service. Moving ahead, in 1990, the state of Alaska won a big settlement of several oil tax lawsuits, and we created something called the Constitutional Budget Reserve, or the CBR, to stash that money in. And we use the CBR in Alaska as a buffer account to draw on when oil prices and tax revenues are low, and of course we pay it back when prices are high, as we've done so over the past 8 years or so. The CBR, the Constitutional Budget Reserve, currently holds about $8 billion. And the CBR can be accessed by a 3/4 vote of the legislature, and that will be important to remember later. It plays a part in our current situation. Oil flowing through the Trans-Alaska Pipeline System, or TAPS, peaked at about 2.1 million barrels per day in 1988, but has declined to about 530,000 barrels per day today. Now, high oil prices, increasing oil prices, have masked the effects of declining production for many years. And as recently as fiscal year 2014, our state budget has balanced at prices of about $105 per barrel. Also, parenthetically, petroleum revenue is at least 75% of the state of Alaska's income. The rest is roughly evenly split between federal money and permanent fund and other investment income, plus some taxes on fishing, mining, booze, and tobacco. But we are an oil state. Most of our money and almost all of our economy is based on oil. So when the oil price crash hit Alaska, it hit us hard. Oil prices dropped from about $110 a barrel in July of last year to about $60 per barrel in less than 6 months. And just some numbers to show you what the effect is in our finances. The actual fiscal 13 revenue, unrestricted general fund revenue, which is primarily oil revenue, in FY13 was $6.9 billion. The actual FY14 revenue dropped to $5.4 billion. The forecast FY15 revenue is $2.2 billion. And the forecast for next year, for fiscal 16, is also 2.2. So we dropped from almost $7 billion revenue to just over $2 billion revenue in just about a year. And of course, right now we have a $3.9 billion deficit in the current fiscal year 15, and we project a similar deficit for fiscal 16. And our Department of Revenue predicts, well, actually they hope, that oil prices will rise to about $80 per barrel by fiscal 17. Just parenthetically, the current oil price crash carries echoes for many Alaskans of the mid-1980s, when we had a huge economic crash in the aftermath of our pipeline construction boom. That crash saw the real estate and banking industries take tremendous hits. We lost more than 30,000 people from a population of about 500,000, and really the economy didn't really start recovering until the boom we got from the Exxon Valdez oil spill cleanup response, which continued pretty steadily until today. Back to the recent oil bust. Fortunately for Alaska and for Alaskans, we've just in the last couple of years reoriented our oil tax structure. In 2013, we changed our taxes to do better at lower prices and to somewhat abandon the higher prices. Historically, Alaska started off with a low net oil production tax, but our system evolved into a profits-based severance tax system. We also get money from the oil industry through, of course, our 12% royalty, property tax on the pipeline, and corporate income tax. We had a governor, you may recall, Governor Sarah Palin, had a windfall profits oil tax that she called ACES, or Alaska's Clear and Equitable Share. It was a high progressivity windfall profits tax that was great for the state's income when prices and profits were high. We saw tremendous growth in state government, both operating and capital budgets. But ACES had very high progressivity rates that reduced the incentive for the industry to invest in Alaska. So while the high global prices of oil spurred new investment and production increases elsewhere in the country and the world, in Alaska, our investment and production remained stagnant. So after a bruising 3-year battle, I was actually chair of the Resource Committee at that time. After that battle, which we passed in the legislature and was confirmed by a voter initiative, the Alaska legislature passed SB 21, a new oil tax that captured more income at lower prices. And SB 21 also included some fairly generous production tax credits aimed at encouraging continued production from the increasingly high-cost legacy fields like Prudhoe Bay and Kuparuk, and encouraging exploration and production from smaller frontier oil fields as well, satellite fields. Okay, now the guts of the presentation. How has the state of Alaska responded to this significant drop in oil prices and oil revenue? Well, the first rule of holes is when you're in a hole, stop digging. So we have worked very hard to reduce spending. The operating budget for state government operations, exclusive, not including the permanent fund, was about $4.6 billion in FY14. And we just, in our most recent session, passed a budget reducing that by about $400 million, about 8%, give or take. I would note that our budget process has been complicated by the recent election of a new independent governor who was actually a Republican who joined with a Democratic lieutenant governor in a so-called independent ticket, which beat our Republican incumbent. So it's been a new governor and a new political regime here, which has been rather confusing. Our capital budget has dropped from as high as $3.5 billion in recent years down to just about $1.4 billion, and mostly that is a federal match for transportation funds and other federal programs. Incidentally, our high capital spending in recent years helped insulate Alaska from the Great Recession we had in what we call the lower 48. So now we are, what are we doing actually to respond? We are declining to fund the third year of contracts, giving a 2.5% COLA raises to unionized state workers, and making similar cuts to non-represented employees. We put a 5-year moratorium on a program under which the state reimburses 70% of the cost for local school district bonds for construction and maintenance. 30% local for 70% state funds is a very attractive rate and is a holdover from the good old days of the oil wealth. We're also responding by drawing down various accounts that some might call honeypots of money. We have a $2.8 billion statutory reserve fund, similar to our CBR, but without the three-quarter vote requirement. We're drawing down the Power Cost Equalization Fund endowment of about $1 billion. That money is used to, the proceeds are used to subsidize electricity rates for off-the-grid rural villages. And we have about $490 million in a higher education fund, the earnings of which we use to fund scholarships, and we're also drawing down some smaller funds. Another big change in how we tried to reduce spending is that we stopped forward funding public K-12 education. Now, for many years, Alaska appropriated money for public schools a year in advance, and of course that originally required making double appropriations in 1 year. We're now ending that forward funding and, in essence, taking FY17 money for use in FY16. The governor did his part to try and reduce spending by issuing executive orders halting spending on 6 big capital projects, including a massive hydroelectric dam, a road out of the capital, which is isolated from the road system, and a causeway across from Anchorage across the Cook Inlet. Some steps the legislature has taken, to continue, the governor has, however, not imposed any travel freeze or hiring freeze, which would ordinarily be a response to low income. The governor has called for expanding Medicaid, which he says would cover up to 43,000 new Alaskans, and which he hopes would bring in $1 billion, $1 billion in federal money and new jobs, although, frankly, the legislature is skeptical. The legislature is considering borrowing against our short-term future oil revenue by using something called Revenue Anticipation Notes, or RANs. It's not a long-term solution, but it might get us through a short-term cash flow crunch. So these were our quick responses, what Hawkeye on the old MASH show would have called meatball surgery. And in the next year or so, we face the prospect of continuing big cuts on a meatball surgery kind of basis. I'd note that much of the state public in Alaska has perception of bloated state government, which I'm sure sounds familiar to any other state people involved in the state legislature. But Alaska is turning towards consideration of longer-term or structural solutions. Our legislative finance division has a model which shows the effect of various factors on state finances, such as oil production levels, oil prices, oil tax levels, the effect of income or sales taxes, and different operating and capital budget levels, and so forth. That model is fairly gloomy. It shows that in Alaska, cuts alone cannot balance our budget, and even dramatic increases in oil prices can't overcome the low production levels to eliminate our structural deficit. That model shows that unless we find new revenues somehow, our easily accessible reserves and other accounts will be exhausted in a very short few years. And regretfully, that model doesn't show us what we should do. That's up to us in the legislature. Some options that are being kicked around for structural long-term changes. One, our state think tank, the Institute for Social and Economic Research, or ICER, has proposed a model of sustainable state spending that in essence would combine all of our assets, including the past oil production capitalized and saved in our Alaska Permanent Fund, plus all current and future income from taxes and royalties, which he calculates would be about $139 billion. We would then limit state spending to about $5 billion that would spin off each year. Theoretically, this could work. It would require us to get down to a sustainable budget, and it has some adherence, but it's not drawn any legislator interested in offering a bill. There's a somewhat similar but more modest proposal that's found its way into legislation. It's called the percent of market value. It would change the management of our permanent fund principal from an investment account to an endowment model. Assuming a 5% return on investment, you could split the proceeds between permanent fund dividends and state government. It doesn't solve all of our problems, but it gets you a long way towards a solution. Now, politically, that's hazardous because it could be conceived as a rate in the permanent fund. Very few legislators have started talking about returning to the state income tax, and 2 legislators have actually introduced legislation to start the conversation. But years of relying on the oil industry and oil taxes to pay our way has made income taxes as much of a dirty word in Alaska as rating the permanent fund. There are some minority Democrats who would like to squeeze more revenue from the oil industry by increasing taxes or by repealing or delaying our tax incentives credits. There's not much chance of either of those in one of the most conservative states and oil-friendly states in the Union, Texas. Our governor has just yesterday announced a conference at which his transition team members want to talk about unspecified revenue options. There's speculation he may want to spend a portion of the permanent fund earnings or impose sales or income taxes. The long-term solution a lot of Alaskans see is a natural gas pipeline. One of our favorite bumper stickers says, "Lord, please give us another pipeline boom. We promise not to waste this one or piss this one away." We have long memories of the pipeline bounty, and the hopes to build a project to bring natural gas from the North Slope to market may bring us up to $4 billion a year, probably in about 10 more years. We are working with the big oil producers as equity partners, and we're supposed to come back in special session this fall for another round of commitments. How are we doing on time, Ben?
You're doing okay.
Okay, just going to the wrap up. Okay, another structural problem we have. Remember earlier I said Alaska has about $8 billion in a constitutional budget reserve to pay the bills when oil revenue has crashed? Remember also that I said it takes a 3/4 vote to access this money. That's the root of the big problem we're facing right now, today in fact. When we do have 3/4 supermajorities in the House and Senate, we get that 3/4 vote to access the CBR easily. And even in the past, when we did not have the full supermajority, it was fairly easy to buy minority votes by spending on their priorities such that they would agree to vote. But this year, after seeing very significant cuts to state government, our House Democratic minority is refusing to give us the votes necessary to access the CBR unless they get more than $160 million restored of our $400 million cuts, and they also want Medicaid expansion. 2 weeks ago, our legislature passed a budget that lacks full year funding. We just don't have the money available. So the governor has called us into special session and proposed a budget of his own that adds about $50 million and also calls for Medicaid expansion. We are currently on recess from that special session while our finance committees work on the governor's new budget, and that's where I'm headed right after this webinar. So to conclude, in Alaska, the oil price crash is having a profound and far-reaching impact on our state's people and its finances. We're responding by cutting our spending, draining our reserve accounts, cutting back state assistance to local governments and school districts. We are considering new revenue sources and new ways to structure our main investment accounts. And we are frankly having a very fairly emotional public discussion about what state government should do, what it should pay for, that really goes to the heart of our fiscal system since we struck a rich on oil in the 1970s, answering the question, what do we do when the oil money runs out? And how it does work out is still very unclear, but as always is true in Alaska, it's absolutely fascinating. I appreciate you letting me share my experience and our perspective with you, and I'll do my best to answer questions when the time comes. And again, thanks to Ben and NCSL for letting me present this information.
Well, thank you very much, Representative Sadler. That was extremely informative. We look forward to hearing your responses to a couple of the questions we've been getting in. As a reminder, you can type your question in the chat box at any time. We'll hold them until the end of our second presentation. And now I am pleased to have with us Brian Sigritz, Director of State Fiscal Studies from the National Association of State Budget Officers. Within NASBO, his responsibilities include tracking and analyzing economic, tax, and revenue trends. He also monitors the fiscal health of states and annually produces NASBO's State Expenditure Report. Prior to coming to NASBO, Brian worked as a legislative aide in both the Ohio Senate and the Ohio House of Representatives. Brian, the floor is yours.
Great. Thank you, Ben. Like Ben said, I'm from NASBO, and for those of you that don't know, we represent the governor's budget side, so we deal with the executive branch instead of the legislative side. What I thought I'd do here today was kind of start off with a quick overview of current state fiscal conditions for all 50 states, and then kind of dive in on the impact of the oil price decline on the severance tax states, look a little bit at some individual states that rely a lot on oil. Representative Sadler did a really good job overviewing Alaska, so I'll touch on a couple of the other states. And then I'll close with talking about an outlook for the different severance tax states or energy states. So starting off with an overview of current state fiscal conditions, what we're seeing right now is continued slow growth for states. All states, except for New York actually right now, is currently in fiscal 2015. And for this, we've seen the 5th straight year of growth in both general fund spending and general fund revenue. The signs of fiscal distress have definitely lessened. Most states are seeing a little bit more stability and slow growth. That's not to say that all states are seeing growth right now. We've had states impacted by various different factors. Some of the states around here in D.C., Virginia, Maryland last year were really impacted by some of the federal spending declines. We had states that have been impacted by some tax-related changes. States also continue to deal with issues such as pensions. And then, of course, all the declines in the oil prices have really impacted a number of states. So even though we're seeing growth, it's still been slow growth, and states really haven't returned to normal patterns of growth. This slide kind of shows that. So this is on general fund spending. This comes from our fiscal survey of states, which we release twice a year. So you can see, 2009 and 2010 were 2 straight years of outright general fund spending declines. And that's the first time that, since we've been tracking this data going back to the late 1970s, that we had 2 consecutive years of general fund spending declines. Now we've had 5 straight years of growth, but the issue is all 5 of those years have been below the historical average. Typically, we see state general fund spending growing about 5.5%, and all those years have been below it. Looking so far at proposed budgets and some enacted budgets for fiscal 2016, I think it's likely that we'll see another year of spending growth, but once again below the historical average for state spending growth. As far as general fund revenue, this follows along pretty closely with what we're seeing with general fund spending, not surprisingly, since for the most part, states can only spend as much money as they take in. Once again, we've seen 5 straight years of revenue growth, but it's been slow growth for the most part. And actually, if you adjust fiscal 2015 revenue for inflation, we're still below the level where we were before the downturn. So looking a little bit more at fiscal 2016 budget proposals, a lot of governors started off noting about the economic improvements in their state since the end of the downturn. That's kind of a common theme we saw in both state-of-state speeches and in proposed budgets, talking about lower unemployment, increased consumer spending, etc. A number of governors discussed different infrastructure proposals or education proposals, but the majority of the budget recommendations still included pretty moderate both revenue growth and state spending increases. We weren't seeing, double-digit growth in most states or anything like that. Most states are kind of maintaining their reserve levels. Some states are dipping into it a little bit. So overall, I say that states remain very cautious here going into fiscal 2016. The current revenue outlook, through March, what we were seeing was, once again, slow revenue growth. It seemed like most states were hitting their revenue projections. They were either on target or slightly below or slightly above their projections, although we did see a handful, a dozen or so, maybe a little bit more states that were coming in below projections. Of course, a lot of those were the oil states. But looking at April, it seems like most states are having a pretty positive April surprise. So I think we're going to see more states kind of come in with revenues above projections when we conclude fiscal 2015 here. But the April surprises aren't necessarily because of the sudden uptick in the economy. They're more because of the strength of the stock market in calendar year 2014. So now that everyone is submitting their tax returns, states are seeing a revenue bump because of that. And as I mentioned, most states are seeing revenue increases. The severance tax states are still seeing declines in those areas. So the reason for the oil price declines, some of this you might be aware of. A lot of it has to do with supply and demand. The U.S. especially has increased their oil supply the past couple of years, as well as some other countries. Demand has remained pretty stable, though, or even gone down some in some countries, as the world market and the economy really hasn't picked up that much in a number of areas since the downturn. Back in November, OPEC failed to agree on cutting oil production. This is kind of led by Saudi Arabia, who didn't want to see reduction and has the reserves to kind of tolerate the lower prices. So the Saudis' hope is kind of that the low oil prices will kind of clear out the market a little bit, and some of the oil rigs in the U.S. and the other countries will have to, the ones that aren't profitable, these low prices will have to stop. And the oil speculators also played a little bit of a role in the oil price declines. The economic impact for states, it really depends on if you're a severance tax state or not. Most of the states that aren't severance tax states, the oil price decline has been at least somewhat of a positive for them. The thinking was that with people spending less at the gas station, less at the pump, that they would have more money to spend on other items, so you see an increase in consumer spending. But we really haven't seen much of a growth in sales taxes. So I'm not sure how much of an increase is actually going on in that area. A lot of states, especially through April, were saying that personal income taxes were really picking up, but sales tax growth is still sluggish. Another school of thought was that people would drive more with oil prices being lower and gas being cheaper, but a lot of times you really don't see that when gas prices drop. You might see a slight uptick in the number of miles driven, but you don't see people all of a sudden driving twice as much as they were before. So the overall impact in the states really depends on if you're a severance tax state or not. Most of the severance tax states, any kind of economic improvements on the consumer spending side aren't going to be enough to outweigh some of the declines on the oil price side, especially for the states that rely heavily on severance taxes. So it's kind of a divide. If you look at how much, the states that produce a lot of oil, Texas, these are coming from the U.S. Energy Information Administration. It looks like totals in February. Texas, by far and away, produces the most oil. North Dakota, California, Alaska, etc. But some of these states, Texas, California, Colorado, even though they produce a lot of oil, they're not nearly as dependent on severance taxes, and their overall economy isn't as dependent. So they have a little bit greater diversification. So the declines in oil prices, while they've been impacting them, haven't been impacting in quite the degree of what we heard in Alaska and other states. Representative Sadler referenced this. This is coming from the Census Bureau. You see the percentage of overall state tax collections that come from severance taxes. So these are taxes on oil, natural gas, and coal, not just on oil. But Alaska leads the way here, according to the Census Bureau, of about 72% in 2014. And North Dakota also receives over half their money from severance taxes. So states like this are the ones that are really being impacted by the oil price declines. A couple of these slides that come from IHS. We were at our spring meeting a couple of weeks ago, and we had a speaker from IHS who gave a really good presentation, so he let me borrow a couple of his slides. But they were looking at the oil rig decline, how it correlates with the drop in the price of oil. And we really have seen a pretty strong correlation. As the price of oil started dropping, the number of oil rigs dropped right along with it. Their expectation is that the oil rigs will probably hit a low point sometime the end of the second quarter, so sometime end of June or so. Then it'll kind of stabilize or may eventually start to see an uptick again in the number of oil rigs. We've also seen a sharp drop-off and economic growth in the energy states, most notably in North Dakota. But all these states listed here, you reduced their economic growth forecast since November. Some states like Texas are still seeing pretty positive growth, but even Texas has kind of reduced their economic growth forecast. And also, not surprisingly, going along with the decline in number of oil rigs and also the decline in economic output, we've seen a reduction in job growth in all the different energy states. So some of the individual severance tax states, so these are states both that rely on oil and also states like West Virginia that get a lot of coal and natural gas. Happened in North Dakota, they did reduce their revenue projections by about $870 million for the new biennium. They just recently passed a new oil extraction bill. The hope there by the governor and the legislature is that will kind of lead to greater predictability on what oil revenue is going to be. The governor also made remarks that he's hopeful that you'll start to see a rebound in oil prices by the end of the year. Wyoming is in the middle of a biennium budget. They do a biennium budget different than most years, than the years of most other states. But they did a supplemental budget recently, and they were hoping to put $200 million extra into the rainy day funds or the reserves, and they weren't able to do that. They also just created a task force on mineral taxes, so they're similar to North Dakota. They're going to be examining their severance tax structure. New Mexico just passed a budget with very slow spending growth at 1.3%. A lot of this is because of the decline in price of oil. West Virginia, I did these slides earlier this week, and that's actually out of date now. West Virginia, I have on the slide here, is looking at a deficit for fiscal 2015. They're now looking at probably hitting their revenues on target for fiscal 2015 because their April revenues came in above projections. But that's all due to personal income taxes and other taxes. They're still seeing the decline in severance taxes. Montana, they actually increased their revenue projection, but once again, it wasn't anything to do with oil. They were projected increase in personal income taxes and other sources, and they're still projecting a decline in oil prices. Texas is still having pretty strong revenue growth, although they are expecting a slowdown in oil exploration and are expecting it to impact the overall state economy, although overall Texas is still doing pretty good. Their big debate right now is kind of the size and scope of tax cuts, so they're still looking at pretty healthy growth there. Louisiana is facing significant problems. Some is due to the oil, but some is also kind of dealing with long-term issues that they've been facing. I think they're looking at about a $1.6 billion shortfall in 2016. And Oklahoma, this is another state that they just came out with an update. Looks like their April revenues were above target. But once again, it's because of income taxes, and they're still facing oil prices. They're still dealing with lower severance taxes. So to close out by talking about the outlook here for severance tax states, and then I'll be happy to take any questions. The expectation is that oil prices will rebound, kind of going the rest of 2015 into 2016. I was looking earlier, it looks like Brent crude's about $65 a barrel today, so definitely up above where it was end of last year and earlier this year. U.S. Energy Information Administration is thinking oil might be up to around $75 a barrel in 2016. Even with that, severance tax states are going to continue to have some of the most volatile revenue sources. We really see big swings in the severance tax states. I think having a volatile revenue structure is kind of somewhat got a bad rep. A lot of states would kill for kind of the volatility that North Dakota was experiencing here the past couple of years. So volatility in itself, I don't think, is a negative, but states got to be careful how they deal with volatility. And most of the energy states have done a good job of building up reserves and rainy day funds, which can kind of help you weather the storm when some of the severance taxes start declining. And I think it's likely you're going to continue to see some of these states examine their tax structures, just as Alaska did a couple of years ago, and North Dakota, Wyoming, some of the states have done recently. And, kind of similar to the non-severance tax states, I think the severance tax states are going to see continued slow growth. We're not expecting big upticks in spending or revenue, kind of going forward here in the next couple of years. State budgets are likely to continue to be constrained, and states are going to have to continue to make some painful choices. We're still seeing slow economic growth. Job figures that came out today were pretty positive, but it's not. The first quarter GDP was very weak, so we're still experiencing slow economic growth. Some uncertainty remains about future federal funds. Of course, states are still facing some of the infrastructure demands and dealing with long-term liabilities. So I think going forward here for both severance tax and non-severance tax states, you're going to continue to see slow growth and kind of cautious state spending. So with that, my contact information is up on the screen now. If anyone ever has any questions or anything, feel free to contact me, and I guess I'll turn it back over to Ben.
Thank you, Brian. That was a really great overview of the current situation facing many states. Before we move into our question and answer portion, I want to point out two important resources. First and foremost is for those interested, you can actually download today's slide deck right now. To do this, just click on the library button in the upper right hand. That's the blue and yellow icon button. That'll open up a new window allowing you to start downloading today's presentation. The second resource, which is also available in the library, is we've made available an article from NCSL's February edition of our State Legislatures magazine by Arturo Perez, who is NCSL's Fiscal Program Director. He's actually been kind enough to join us for the question and answer portion. I'd also stress that Arturo is a really great resource on this issue, so please do not hesitate to reach out to him if you have any concerns going forward. With that, I'd like to move into our question and answer session, and we've already had a few questions come in, which I'm hoping our speakers won't mind answering. But as a reminder, if you do have a question, please type it into the box in the lower left. And of course, as this webinar is being recorded and will be made available for downloads afterwards. So Representative Sadler, if you don't mind, if I could start with you. One of the questions that came in, is there, and I'm just kind of paraphrasing this, is there kind of a long-term price that Alaska is looking at that would kind of provide some level of budget stability? Obviously, the quick drop-off and some of the recovery that we've seen in the oil price, but I didn't know if there was one that the legislature has either researched that would provide some level of stability towards the budget.
Thanks, Ben. I have to say that no, there is not a specific price level. We have always kind of calculated the level at which our budget would balance at different price levels, but since the large free fall in oil prices, we've kind of gotten unmoored from the connection. So it's going to be a matter of recalibrating what services Alaskans want and what level of oil income we are going to have to receive that. Again, I'll draw the distinction because it used to be in the past that higher oil prices, when combined with our high production, could fix things. The old joke was, or the old saw was, a dollar change in the price of crude was $100 million to the state treasury. That calculation has gone cattywampus, and so the short answer is no. We really don't know what price level we need. It's going to require us to recalibrate what we're willing to pay for, because oil can't pay for it all. We're going to have to find other revenues, likely.
Great, thank you. This next question is kind of for all three of you. It might be geared a little bit more towards Brian and Arturo. We actually got two of this very similar theme question. Representative Sadler talked about the negative impacts on Alaska. Brian, you talked about kind of some of the negative impacts on some of the other severance tax states. If you had to say whether or not the decline was an overall plus or minus for the economy, I realize that's a difficult kind of yes-no kind of question, but I figure I'll put it forward and see what you guys have to say.
I think it's probably too soon to tell. I think the declines probably did contribute a little bit to some of the first quarter GDP being weak, especially when you've seen the drop in employment in some of the states and the decline in miller rigs. So the first quarter might have been overall negative to the economy. I really don't have a good answer, but going forward here, if we start to see a little bit of uptick in oil prices, helping out some of the severance tax states, but not seeing oil prices, go up so high where it's, going back to $4 a gallon and people start driving less or, cut back on their consumer spending, then it might be a little bit more of a positive. But I guess overall, I don't think you've seen, there was some talk in November and December about how much of a benefit this would be to the overall national economy, the drop in the price of oil, and I don't think you've really seen that strong benefit. There's been a benefit in some sectors, and some states might be seeing some benefits, but it hasn't led to, overall, big economic expansion or anything like that.
I would agree with Brian as well that it's still too early to say outright whether this has been an overall benefit and to what degree, but it still bears watching, especially given the recent price changes that have occurred over the last 2 weeks on the price of a barrel of oil. So be watching.
From Alaska's perspective, I think I can say with great confidence that the drop in oil prices has been an unmitigated disaster. Almost the only positive I can see in it is if it does spur renewed public discussion about what level of state government services we need and are willing to pay for, and if it spurs increasing efforts to try and diversify our economy. We did do a good job of saving. The question is, did we save enough, and did we make access to our savings appropriately sidebarred enough? So, no, it isn't bad for Alaska.
Great, thank you. And Brian, this question came in when you had the slide up touching on the number of rigs, and I know you kind of already answered it later in your presentation, but just to make sure I don't not ask it, what other kind of potential variables are there that could impact the price of oil going forward? And I realize that's probably an energy expert kind of question, but it came through, so I just want to see if anyone has any thoughts on it.
Yeah, I mean, yes, I guess number one thing would be always, the kind of the Middle East political climate. Not sure, what kind of impact that could have going forward. Kind of the overall philosophy, I guess, with the OPEC nations and Saudi Arabia. Saudi Arabia seems to be in this for the long game of being comfortable with lower oil prices, but if they start changing their tune, I guess those would probably be two of the big things, kind of off the top of my head.
Thanks.
Ben, this is Dan, Alaska. Could you repeat that question?
Sure. It was really just, and the question came in when Brian was talking, had that slide up, talking or showing kind of the significant and quick decline in the number of rigs within the U.S. And the question was really, what are some other factors that might impact the price of oil going forward?
I don't have a comment for you, sorry.
Oh, no, it's fine. That was actually the last question that we got, and seeing no more, I just would like to, once again, extend a big thank you to our speakers today. And of course, thanks to our attendees for participating in today's webinar. Don't forget to register for the upcoming webinars in the Natural Resources Infrastructure Committee Spring Webinar Series. Thank you again for your continued interest and support of NCSL, and have a great weekend.
Bye-bye. Thanks, Ben.
Thanks.
Thank you.